Great. So September 2015 question 4. September 2015 question 4. Omena Limited is a firm in the manufacturing industry. Omena Limited is a firm in the manufacturing industry. Then we are told that the management of this company are considering purchasing a new machine at a cost of 1.5 million. So 1.5 million initial outlay. This investment is expected to reduce manufacturing costs by 45 million annually. Annually is annuity. And when you reduce manufacturing costs, we increase profits. When you reduce costs, to increase profits. The firm will need to increase its net operating working capital by 12.5 million when the machine is installed. That is investment in working capital. But the required operating working capital will return to the original level when the machine is sold after 5 years. Terminal cash flows, the release of working capital. Omena will use the straight line method to depreciate the machines, and it expects to sell the machine at the end of 5 years operating life for 11.5 million. The company pays tax at the rate of 30% and uses 10% cost of capital to evaluate projects of this nature. For 3 marks, the project's NPV. The project's NPV. Can we have the initial outlay? So the initial outlay in millions of shillings. Do you have the cost of machine? And the machine is going to cost 125. We don't have installation costs here, but I can see we have working capital. So can we add working capital? We invest in working capital of 12.5. So we have our initial outlay of 137.5. So then we have annual net cash flows. Annual net cash flows, miaka yake ilikuwa 5. So we have the year 1 to 5 in millions of shillings. Right. So do you have annual cost savings? Kila mwaka tutasave costs za ngapi? I think 45M. So kila mwaka tunasave 45M. Tukisave costs na increase profits. So indirectly, it's just a different way of saying it will increase profits by 45 million annually over its life of 5 years, right? We less what? We have tax, 30% of 45. $13.5. So less 13.5. Then we add our DTS. Depreciation tax shield. Cost is 125. Salvage value is the money gapping. I think 11.5 paragraph 2. So 11.5 over a life of 5 years. Tax on depreciation, depreciation tax shield. Now we are back. I hope we are audible. Now we had the initial outlay annual net cash flows from our September 2015. September 2015, that is question 4. Now we are on the terminal cash flow, so we have the scrap value of the new machine. Scrap value of the machine is 11.5. Then we also have to recover to add the working capital. Whatever you invested in as part of the initial outlay, you have to recover it at this point. That is 12.5. I see a total of 24 million. 24 million. So therefore, the cost of capital was how much? Cost of capital. The question of we have the cost of capital. 10%. 12, 20, 10%. So NPV at 10%. Sure. So NPV at 10%. But what how much about we? Ya kwanza 38.31 times. Yes, Steve. Sometimes you shine where you can. And it's an annuity for 5 years, right? Which one? That's 8.31. The annual net cash flows, we discount them 10% for 5 years. What we have? Naangalia ni jambo gani unaangalia kama ni annuity ama lump. Annuity is table 2. Annuity is table 2. And what is it an annuity, by the way? Because the 38.31 is coming in annually for each of the 5 years, each of the year 1 to 5. So I'm getting it annually. Annuity from the word annual. That's how. You're saying is 3.7908 plus 24. Let's see, 24 is coming in only once after 5 years. And now there is a lump sum table 1. Hii amount nitaipata tu mara moja at the point of terminating the project. I don't terminate the project annually. I terminate the project only once, right? So after 5 years, that's a lump sum. But the 38.31 is coming in annually for 5 years, annuity. So now you can bring that, that 0.6209 minus the initial outlay of 137.5. What is the NPV for only 3 months? How much? 22.63. Positive, negative? Positive. Great. So that is our 3 marks. Imagine. Positive, negative. The answer. Wakati unachukua hizo zote subtract hii, you get a negative or a positive. When it's a positive, the project is good. It's giving you a profit. If it's a negative, the project is giving you a loss. But we are not. So the positive and the negatives helps us in advising. But in the question, you've not been asked to advise. Labda angetuambia tu advise kuongezeka 1 month. So they should do that next time. But whatever you've done, partly is helping you in part 2. See, it's not in vain. Now let's look at part B. Let's look at part B. Now, part B, we are told the firm's management are unsure about the annual savings in operating costs that will occur with the new machines acquisition. See the aspect of unsure. So there's an aspect of uncertainty. Hapo ndo tunakuja pale kwa zile concepts, the techniques of handling risk. So risk is about uncertainty. We are not certain, so they're not sure about the savings of 45 million. Management believes that these savings may deviate from their best case of 45 million by as much as a plus or minus 10%. So hizi savings za 45 million zinaweza ongezeka na 10% ama zipunguke na 10% because of the uncertainty aspect. Determine the NPV of the project under both situations and comment on the sensitivity of this variable. So NPV under both situations. So hapa we can have plus 10% and we have minus 10%. Ikiongezeka na 10%, what will be our NPV? Ikipunguka na 10%, what will be the NPV? And this is about the sensitivity. Only one variable is affected at a time. In our case, the variable that is being affected is the savings. So whether zinapunguka na 10 ama ziongezeke na 10, initial outlay haibadiliki, inabaki 137.5. EPN 137.5. Annual net cash flows. Annual net cash flows. Yes, today you're not very lucky with us. So whether zina increase na 10% ama zina reduce na 10%, miaka zitabaki 5. Do you have annual cost savings? That is all about following instructions. When you increase the savings by 10%, how much will be the new savings? When 10% of 45, right? My chief? That's 9.9. 49.5. So 49.5. And if you reduce it by 10%, that will be 90%, right? So 90% of 45, 40.5. So you less your tax, which is 30%, and you add the DTS. 30% of 40.5 was already there. 12.15. And 30% of 49.5. 14.85. Then our DTS, see cost haibadiliki, salvage value haibadiliki. So therefore DTS itabaki 6.81. So 6.81, 6.81. And we have our annual net cash flows. But 1.46. Alafu huyo mwingine at 5.16. Terminal cash flows uko nazo, si ndio? Terminal cash flows. Scrap value haikubadilika, working capital haikubadilika. So our scrap value remains 24. Whether savings na increase ama na reduce. The salvage value did not change, and even the working capital did not change. So the investment in working capital, the scrap value ilibaki 11.5, working capital ilibaki 12.5. Nothing changed. The only thing that changed is the savings of 45. It does increase, or reduce. Nothing else is affected. And that is the sensitivity analysis. Only one variable at a time. All other variables. So the NPV under positive 10% is how much? 4.56. That's 4.56. Positive, right? And minus 10%. 10.6. 68. Now, and we have ile NPV yetu ya kawaida without any variation ilikuwa 22.63. They wanted us to comment on the sensitivity. So just say that in understanding what the question is asking about, just say sensitivity. Sensitivity is the percentage change in NPV. Is the percentage change in NPV. From the base to either best case, from the best to either best case or worst case. From the best to either best or worst. So tukiangalia ile ya best ni plus 10%. So remember that the percentage change is always new minus all over all times 100. Percentage profits inakwanga selling price minus cost price over the cost price. The new price minus the old price divided by the old price. So our new NPV is 34.56 minus the original NPV was 22.63 divided by 22.63 and everything times 100%. That is also my good percent. 52.72%. So niko sure because ilikuwa plus or minus by the same percent, if I check the other one, will also be negative 52.72. Can just try direct. Finya tu kwa calc, 10.68 minus 22.63 equals divided by 22.63. Should be able to get a negative 52.7 if our answers are correct.
You did.
52.81, 52.7, rounding off errors. So it's there. So after doing that, now you can give a comment. They wanted us to comment. Wangesema tu evaluate the sensitivity tumefika hapo. But comment ni gani? Hata kwa kuinterpret tu. Savings change by 10%, NPV ina change by 52.7. That's the comment. So when savings change by 10%, NPV will change by 52.72%. When savings change by 10%, NPV changes by 52.72. So how sensitive is NPV to a change in the savings? And you can see it's very sensitive. Una change in a 10%, na NPV na change na 52%. So the higher the ratio, the more sensitive the variable is, the more sensitive NPV is. Sasa una change tuaka kidogo na 10% peke yake, lakini NPV na change na 52%. So that sensitivity is too high. It's very sensitive. NPV is very sensitive. A change in the savings, in the cost savings.
I'm not the same there.
Yes.
It's something that you just say about the higher
Now, the aspect of the higher the sensitivity you must compare. Here is all about the savings. Wangetuambia story za sensitivity maybe kwa initial cost. So una compare what is the sensitivity of the initial cost with the sensitivity in the savings. Ile ambayo iko kubwa sana ndio iko more sensitive. But in this case, you're only comparing one. You're only evaluating one. When you change the savings by 10%. Sasa pale kwa sensitivity analysis ukikumbuka pale tulifanya, walituambia sensitivity of the kulikuwa na selling price, kulikuwa na variable cost, kulikuwa na sales volume. So we are evaluating different scenarios. But hapa ni scenario moja peke yake, si ndio? The savings zina change na 10%. Sasa, so you see, kulikuwa na variable costs. Yeah, kulikuwa na different things, ndio. That's why now when somebody wanted us to comment on the variable that is most sensitive, ile iko kubwa ndo iko most sensitive. So just broadening our minds. Sasa, tuangalie part C. Suppose the firm's CFO. Suppose the firm's CFO suggests that the firm does a scenario analysis for this project because of the concerns raised about data assumptions, particularly the annual operating cost saving, the salvage value, and the net operating working capital requirements. After an extensive analysis, she arrives with the following probabilities and values for the scenario analysis. Now, this question should help us differentiate between sensitivity analysis and scenario analysis. Sensitivity analysis ni variable moja peke yake unaiguza at a time. Like in our case, we only touched the savings. Everything else remained the same. The cost, the purchase price, the cost of the machine, the working capital, the scrap value, zote zilibaki intact. The only thing that changes what? The savings. That is sensitivity. How sensitive NPV is to a given change in a decision variable. One. But now the scenario analysis, you can change this, you can change this, you can change this under different circumstances. And that is what is happening in part C. As you can see, kwa hiyo table hapo chini, we have the worst case, best case, and the best case. Under the worst case, probabilities ziko hapo. Annual operating cost savings, under the worst case, there will be 36 million. Best case inabaki 45, best ni 54. Unaona salvage value pia ina change. So more than one variable is changing at a time. Sasa, best case tulikuwa na 45, 11.5 the salvage, working capital 12.5. Worst case, the three variables are different. Best case, the three variables are again different. So that is the scenario. Determine the project's expected NPV, standard deviation, and the coefficient of variation. Now, when I look at the three scenarios, can I say that I already have the NPV under the best case, which is 22.63? Under best case. See best. annual operating cost savings ni 45. Sindio hizi bado ni 45. Sindio? Then of course, the salvage value is 11.5. Sindio hii 11.5. Sindio? The net working capital is 12.5. Sindio 12.5. So I don't need to repeat base case. They think that. Kwa hiyo base case ya katikati, si ndio? Do you have the annual operating cost savings of 45 million? Yes. Is it what we have here? Yes. In our required number A? Do you have the salvage value of 11.5 million? Is it what we have here? Yes. And do you have the net operating working capital of 12.5? Si ndio iko hapa. So hata nikirudia itapata the same thing. So hakuna haja ya waste your time kujirudia. See that? So that after interpreting and seeing that, you only focus on the best and worst. Because best already work on an NPV. You just borrow it. So if you are in agreement with that, we take care of the two scenarios. We have the best and we have the worst. We have the best and we have the worst. In millions of shillings, we have cost of machine. The machine will cost how much? Whether it is best or worst, you 125. Clear? Hiyo hajasema itabadilika. Right? Do you add the working capital? Under the best, what is the working capital? I think 10. And under the worst, 15. So initial outlay, this is 135, and this is 140. Yeah. So this is our IO, annual net cash flows. Annual net cash flows, of course, miaka ni tano, year 1 to 5, year 1 to 5. Do we have annual cost savings? Yes. Under the best case, you are saving how much annually? 54. And under the worst case? 36. So interpretation is the key. We less what? We less tax. 30% of 54 and 30% of 36. Yeah, 54. 16. 16.2. And 30% of 36. 10.8. We add our DTS. Now, under the best case, cost of the machine, 135 or 125. We need to depreciate now. Cost me 125 or 135? 125. You saying that? The working capital is never part of them. It's never depreciated. Clear. Salvage value ni ngapi under the best case? Are you seeing 14? So minus 14 for 5 years times 30%. 6.66. What of the worst case? Cost ni ngapi? Bado ni 125. Na salvage value ya worst case 9. Kwa miaka 5. That's 30%. Six point 96. So do we have our annual net cash flows? So since like kuna project tatu. Project ya kwanza ndio hii, ya pili ndio hii, ya tatu ndio hii. That's the first one. 44.46. And the worst case? That's 2.16. We have terminal cash flows. Scrap value. Under the worst case, what is the scrap value? You have said the depreciation is 14. And under the worst case, 9. Do we have the working capital? So we add the working capital. So working capital is it 10 and 15? 10 and 15. Something this is 24. It's also 24. Yeah. Then of course we now need to get the NPV. NPV is 10%. So your best 44.46 times 3.79 3.7908 plus 24 times 0.6209 scale 6209 minus initial outlay of 130 135. Tunapata hiyo sio? Alafu tupate NPV ya worst 32.16 times 3.7908 plus 24 times 0.6209 minus initial outlay of 140. So can I get the two NPVs? Okay. Jadi ya kwanza na ya pili negative syntax error. Usifute syntax error. Nilikuchanua.
Otherwise, you will do it.
Sawa. But I want you to allow you to do it mpaka mmalize. So still give me 1 minute. Still give me 1 minute. Because I want us, as you do it, I want you to recall something. If you got to memorize that term, say it as at all. So in summary, we shall have, we need NPV and the probability. NPV at best, the 48.44, probability at best, swali ni ngapi? 0.2. Best is 0.2. NPV at best is 22.63. What is the NPV of best? Ya katikati. The probability, sorry. 0.4. And we have NPV of worst, negative 3.18. Probability 0.4. From that information, do you remember how to get expected NPV? Summation. Yes. Yes. NPV times probability. Summation is add. Add NPV times probability. Add NPV times probability. That one is doable, right? Next, they want us to get standard deviation. Can we get standard deviation? Kwa full anzisha. Square root. Summation. NPV. Times Miwongo. Minus. Expected. Times probability. Kuna square kwanza. Shine where you can. Hiyo ndio kitu ameuliza. Alafu ameuliza pia CV. How do you get CV? Coefficient of variation. Let's be accepted. Risk by formula yake inasema nini? R replaces NPV. ER is expected NPV. So it's R is NPV instead of R. Right. Yes.
Also, it's the same thing.
Hivi sasa huku tuko na return tuko na NPV, lakini hapa tuko na NPV. So R minus ER, NPV minus ENPV. Now, suppose tuko na probability, we don't divide by n minus 1.
No,
In absence of. Thank you. So CP equals to, because you're already in that page. No maandika na handwriting nzuri. Hata formula ya CP. So standard deviation over expected. NPV. No. There's 100 to 1. Where's the victory? Now document.
Ama aliveness. Ali very yeah something. We are in something.
But if you control of them, I can't get out.
We are more. Najua anashughuli tumestart sana. Kwa hiyo so ndio habari za jioni. Nasikia kuna dawa. Ani ile mimi sio kazi. Okay. Don't be about it. Hivi ndio ndio kwa na unaona hiyo swali bila haina hata tafadhali. Oh yeah. Sawa. Tena mkapo kwa coefficient. No coefficient. LBP na
Then maybe, see you. It's always with the label.
summation sana.
Then I idea, some is from all, you know, expected then maybe, it's not very expected. But it's another thing will be expected anything. So it's all like that they will put up. It's even.
So you can do something.
It's not, it's sometimes. No. These days, these days, it's not funny.
Oh.
Yeah. But then your answer, you know. Then when just an integration, you have to take up. So you have a better CD. So just. When they get to the cup, we have to make a money with them. Again, what you want to do for is to
I didn't.
we got from there.
It was already around.
Oh, assumption, but we feel.
So that means you're adding for this. Without probability. Is it? I think that's that. You see, if you are against PNPP,
I think what is.
is you multiply and divide. That is now when you get PNPA, this answer. So the sum.
I think none of the final solution yet, we're going to do it beyond that's expected and the total period of the 1.8 plus. I'm going to be after the event of
So it's not well. That means you don't have the ways of
so what we do.
There's somewhere.
hii ni gani? Hiyo ni gani?
LPP gani?
Hii ndo tunasema summation ya LPP.
Si LPP ndio hii.
Unaongeza hizo. Kila kitu kwa
NPV minus expected NPV squared times the probability plus NPV minus expected NPV squared times the probability plus NPV minus expected NPV squared times the probability. What is the expected NPV? Kwanzia how much?
1, 2, I'm not sure. I thought
Tunashuku majibu yako. So 48.44 times 0.2. I'm also doubting it cannot be negative. 17.46. Yeah, because in positive, in positive, negative is only 3 times 0.5. Yes, negative. 17.46. Yeah. Now the standard deviation. The standard deviation. So tuko na NPV ya kwanza 48.44 minus 17.46 squared probability yake ni 0.2 plus NPV ya pili ni 22.63 minus 17.46 squared, probability yake ni 0.4 plus NPV ya tatu negative 3.18 minus 17.46 squared times 0.4. Your answer unapata squared. Now it will be a poor. The last part we are told that if NPV of this project is less than 5 million, the company will be exposed to the hostile takeover. If NPV is less than 5 million, the company will be exposed to the hostile takeover. Then determine the probability that this company will avoid the hostile takeover. Assume normal distribution. When you say normal distribution, you think about what? That mountain, right? So you think of that mountain. So you have hapa katikati, si ndio mimi? Na mean yetu ni expected NPV ambayo ni ngapi? 17.46. So that helps us to know ile NPV tumeambiwa ni 5. If it's less than 5 million, there is hostile takeover loading. They want us to, our target NPV is 5 million. So your mountain inasaidia kujua your 5 million iko on the left ama on the right of the mountain. Is it on the left or on the right? The 5 million is before 17, right? Kwa hivyo 5 million yako inakuja hii side. Ingekuwa 20, ingekaise greater than 17, right? So hapa ni 5. Of course, standard deviation yetu tulikuwa tumepata 19.32 or 31 there. So they want us to determine the probability of avoiding the hostile takeover. Now, for the company to avoid a hostile takeover, its NPV should be 5 million and above. But if it's less than 5 million, then there's that probability. They want us to avoid. To avoid it, it should be 5 million and above. 5 million and above. hii side. Wangeuliza probability of experiencing the hostile takeover ingekuwa less than 5 meters, so ingeshare. Ndio. Then you look for the area under the curve, formula yake tunakumbuka. NPV minus expected NPV divided by what? Standard deviation. And then fungus x minus x bar, g mu minus g what minus mu. Zile lugha zingine, but for finances. NPV minus expected NPV divided by the standard deviation. Our NPV is 5. Our expected NPV is 17.46. And our standard deviation is 19.32. You ignore the sign. 2 decimal places. Ignore the sign. 0.64. 0.64. So 65. So it's 65. 2 decimal places. Then you go to the table that has a mountain in your past compass. Hujapata yote.
Na mimi nimeweka nimejolea.
Umeshatolea zote mbili.
Kumaanisha mdani.
Yeah, you have some marks, but not all the marks. Umepata table. Must be somewhere. Good. So when I look at the tables, known as zimeshediwa quarter. Sindio? Lakini shaded region yangu ni 3 quarters. What am I talking about? When you read in that table, you'll only be getting the quarter part. But you know there is a quarter and there is 0.5. Kama hiyo table ingekuwa imeshediwa 3 quarters. Na hapa pia nataka 3 quarters. Then ungeisoma once na ukapata the final answer in the table. But the table imeshediwa quarter, but we are looking for 3 quarters. Shading inaweza kuwa hii side or hii side, it doesn't matter. Sawa. So therefore we check in that table, what is 0.65? 0.6 iko somewhere hapa, na hapa kuna 0.05 somewhere. What is here? So hapa kuna 5. 0.65 you have? 0.2422. Hiyo ni kutoka hapa mpaka hapa. Tunaongeza 0.05. Because our half is 0.5. So 0.2422 is only the quarter. The table is always a representative of the shaded region. So what you read in the table is what is represented by the part that is shaded. So therefore, our probability of avoiding hostile takeover becomes 0.7422. Ama 74.22%. Any spelling?
I'm getting the 0.5.
0.5 is the half.
Automatic.
From here to here is 1. Divided into 2. 0.5, 0.5. Great. That's it.
This we are explaining with.
Yeah. Just one question. We're going to talk about based on the estimation of 4 to 65. And probably they did it based on the question that was asked. That question will take about. This question again. So maybe the examiner was so generous this so that when we do Japan question 6 weeks, you don't need to be given that because you read it in there. I think that is okay. Yeah. Can we just introduce the next one? Taka swali. So let's just do the introduction so that we set the space for the question. The question to do on Thursday. The next one is which one? The next technique of handling risk. Wow. Close the tab. 812. Let's go.
We supposed to continue bomb allowance.
6 hours. 6 hours when there is